$130 per ounce. That's what physical silver sold for in Tokyo on January 1st, 2026. At the exact same moment, the official COMEX price on your trading screen showed $72, an 80% premium, the largest divergence between paper and physical silver prices in the history of modern commodity markets. This isn't a typo. This isn't a regional anomaly. This is the moment when 50 years of paper-based price discovery began to die. While Western traders watched fireworks and clinked champagne glasses, something broke in the global silver market. Not a correction, not volatility. A structural fracture between what screens say silver is worth and what it actually costs to hold the metal in your hand. The data is undeniable, and what it reveals changes everything. To understand why silver is now trading at two completely different prices depending on where you stand on the planet, you need to understand how the silver market has functioned for the past 5 decades. Since the early 1970s, the price of silver has been discovered not in physical markets where actual metal changes hands, but in futures markets in New York and London. COMEX in New York and the London Bullion Market Association have served as the global benchmarks. When Bloomberg or CNBC shows you the silver price, they're showing you the price of a paper contract, a promise to deliver silver at some future date. Most of these contracts are settled in cash. The actual metal rarely moves. The system worked as long as there was enough physical silver available to back the paper promises. It worked as long as anyone who wanted delivery could actually get it. It worked as long as the arbitrage between paper and physical remained tight enough that the two prices moved in lockstep. That system is now breaking apart in real time. The official narrative from exchanges and financial media is that everything is functioning normally. Year-end volatility, seasonal adjustments, technical factors. But the math tells a different story. When physical silver trades at an 80% premium to paper silver across multiple major markets simultaneously, one of two things must be true. Either the paper price is artificially suppressed below its true market value, or there isn't enough physical silver to back the outstanding paper contracts. Based on the evidence now emerging, both appear to be happening at once. The timeline of events that led to this moment begins not in Tokyo or Dubai, but in Beijing. On January 1st, 2026, the Chinese Ministry of Commerce activated a new export licensing regime for silver, tungsten, and antimony. Under the new system, Chinese companies can no longer freely export silver. They must obtain special government licenses. To qualify, firms must demonstrate annual production capacity of at least 80 tons, maintain credit lines of $30 million, and prove consistent export records from 2022 to 2024. Only 44 companies received authorization to export silver during the 2026-2027 period. 44 companies now control approximately 121 million ounces of annual silver exports. That represents between 60 and 70% of all refined silver traded globally. Beijing didn't ban silver exports. They created a choke point, a government-controlled gate through which the majority of the world's tradable silver must now pass. China exported over 4,000 tons of silver in the first 11 months of 2025, while importing only 220 tons. They were net suppliers to the world. Now, with a single policy change, that supply is subject to state approval. This mirrors exactly what China did with rare earth elements a decade ago. First, establish dominance in refining and processing. Second, implement export controls framed as environmental and resource protection. Third, use that control as leverage in trade negotiations and industrial policy. Silver has now joined that list of strategic resources. But China's export controls alone don't explain why physical silver is trading at $130 in Tokyo, while COMEX shows $72. The premium existed before January 1st. It accelerated after. The real story lies in what happened inside the Western financial system during the final week of 2025. On December 26th, the day after Christmas, the Federal Reserve Bank of New York executed an emergency lending operation to an unnamed financial institution. The amount was $17 billion. The borrower's identity? Classified under Federal Reserve disclosure rules. We won't know who needed that emergency lifeline until 2027 at the earliest. Then came December 31st. The Fed's Standing Repo Facility recorded its largest single-day usage in the program's history, $74.6 billion. Banks and other eligible institutions borrowed against $31.5 billion in Treasury bonds and $43.1 billion in mortgage-backed securities. This exceeded the previous record of $50.35 billion set just 2 months earlier in October. The Federal Reserve had removed daily borrowing limits on the Standing Repo Facility in November, creating what internal documents called operational flexibility. The unofficial translation? Unlimited emergency lending with no ceiling. Connect the events. December 11th, the Fed removes borrowing caps. December 26th, a secret borrower takes $17 billion in emergency funds. December 31st, record repo operations inject $74.6 billion into the banking system. January 1st, physical silver premiums in Asia hit 80%. This isn't coincidence. This is correlation. The first delivery report of 2026 from CME Group revealed something unprecedented. JPMorgan, the bank that had maintained massive short positions in silver for over a decade, was aggressively standing for maximum physical delivery. Not rolling contracts to future months, not settling in cash, taking actual metal. Over 1,000 contracts on a single day went to physical delivery in early January, thousands more month to date. From short and hope for lower to take it all in physical. A complete strategic reversal from the institution that has dominated silver futures trading for years. But here's the problem. There isn't enough tradable silver available to close out the positions that remain open. The CME Group raised margin requirements twice in 48 hours during the final week of December. The initial margin for March 2026 silver futures jumped to approximately $25,000 per contract, up from $20,000 earlier in the month. The Shanghai Gold Exchange raised its silver margin to 20%. Market analysts who've studied previous silver peaks in 1980 and 2011 noted an uncomfortable parallel. In both cases, aggressive margin hikes came near historic highs and triggered forced deleveraging. The question now is whether the current margin increases are cooling speculation or flushing out traders who were positioned correctly. The structural supply picture makes this situation fundamentally different from previous cycles. COMEX registered silver inventories have collapsed by over 70% since 2020. The metal that is supposed to back futures contracts has been steadily draining from exchange warehouses for years. At the same time, industrial demand has surged beyond anyone's projections. Silver is no longer just a precious metal, it's a critical industrial input. Solar panel manufacturing alone now consumes a significant share of annual global production. Every high-efficiency photovoltaic cell requires silver paste for conductivity. Electric vehicles use substantially more silver than internal combustion engines. Advanced semiconductors require silver for bonding processes. AI data centers are driving solar and chip production simultaneously. Throughout 2025, industrial demand from AI hardware and renewable energy infrastructure consumed an estimated 60% of total global silver production. That's before investment demand, before jewelry, before coinage. By late December, COMEX faced delivery demand of nearly 65 million ounces, a volume that the exchange reportedly struggled to fulfill. Rumors circulated of cash-only settlements, where buyers who wanted physical metal were offered money instead because the metal wasn't available. The silver lease rate tells you how much it costs to borrow physical silver for a short period. Under normal market conditions, this rate hovers around 0.25%. In late 2025, silver lease rates spiked from 0.25% to 200% overnight. Traders immediately withdrew from the lending market. A 200% lease rate means physical silver became nearly impossible to borrow at any reasonable cost. That's not a functioning market. That's a market screaming that metal has disappeared. The London Bullion Market Association reported vault holdings of 844 million ounces in October. Yet the market couldn't deliver 1,000 tons without lease rates exploding. The discrepancy reveals what insiders have long suspected. The vast majority of that vault silver belongs to ETFs and isn't available for trading. JPMorgan reportedly had to lease 4,000 tons from ICBC, the world's largest Chinese bank, to cover obligations. The biggest American bank borrowing metal from the biggest Chinese bank to meet delivery requirements. Meanwhile, in Shanghai, physical premiums exceeded $8 per ounce above COMEX prices throughout late December. Chinese buyers offered foreign suppliers $8 premiums to secure metal. Indian buyers offered $5. The arbitrage should have closed these gaps. In a functioning market, traders would buy cheap COMEX contracts, take delivery, and ship metal to Asia where they could sell at higher prices. That arbitrage isn't working. It isn't working because the metal isn't available for delivery at the COMEX price. The paper price is a fiction. For over 50 years, the global price of silver has been discovered in the futures markets of New York and London. The current $60 gap between paper and physical suggests that era is ending. This shift fits into a broader trend of commodity de-dollarization, where BRICS nations and Asian markets are establishing their own physical-backed exchanges. Industrial users in the semiconductor, electric vehicle, and solar sectors are increasingly bypassing Western exchanges to secure physical metal at any cost. These aren't speculators making bets. These are manufacturers who need silver to build products. Analysts have noted that prices near $134 per ounce would wipe out operating profits across the entire solar industry. At current physical premiums, some manufacturers are already facing that reality. The bank participation report revealed 8 major banks collectively short over 212 million ounces of silver as of early December. 212 million ounces that may not exist in deliverable form. If silver reprices to physical market levels, those positions face margin calls that dwarf anything seen in previous precious metals squeezes. This is why someone needed $17 billion from the Fed on December 26th. This is why $74.6 billion flowed through the Standing Repo Facility on December 31st. Banks with unhedged short positions in a market where physical supply has vanished need emergency liquidity to survive. The U.S. government is now paying attention in ways it hasn't before. The Bureau of Industry and Security is scheduled to conduct a review in January and February to determine if silver poses a threat to national security. The United States currently relies on imports for 64% of its silver needs. Silver is in every Tomahawk missile, every advanced fighter jet, every satellite system, every piece of military electronics. In early November, the United States added silver to its critical minerals list, but designation doesn't create supply. The metal still has to come from somewhere. Global silver production hasn't kept pace with demand for years. Mines that were shut during the price suppression era take years to reopen. New discoveries take a decade to develop into producing operations. The supply response to higher prices will come, eventually, but not in 2026, not in 2027, possibly not until 2030. The Great Silver Disconnect of 2026 represents the first major failure of a paper-based pricing mechanism for a critical industrial and monetary commodity in the modern era. Price and value have officially diverged. What comes next will likely define commodity markets for a generation. The queues forming outside bullion dealers in China, Japan, and Taiwan tell the story more clearly than any chart. Physical silver is vanishing from the market. Those who waited to act are finding inventory simply isn't available at any price. Consider the mechanics of a short squeeze in a market where physical supply has evaporated. A short position in silver futures is a promise to deliver metal you don't own. The trade works when prices fall. For over a decade, major banks have maintained enormous short positions in COMEX silver, confident that prices could be managed through paper supply. Create enough contracts, flood the market with sell orders, and prices stay suppressed regardless of physical fundamentals. That strategy works until someone calls the bluff, until buyers stand for delivery instead of rolling contracts. The January 2026 delivery notices show exactly this happening. Buyers aren't rolling, they're taking metal, and the banks who sold those contracts now face a choice. Find physical silver to deliver or default. Finding physical silver in January 2026 means competing with Chinese industrial buyers who are paying $30, $40, $50 above COMEX prices. It means competing with solar manufacturers whose production lines stop without metal. Do the math on a 212 million ounce short position. At a $60 premium to cover versus paper price, the loss exposure exceeds $12 billion. At current physical premiums, it could reach $20 billion or more. For a single bank, that's a solvency event. For the banking system collectively, it's a crisis requiring Federal Reserve intervention. The $17 billion loan on December 26th wasn't routine liquidity management. It was a lifeline to an institution facing margin calls it couldn't meet. The $74.6 billion on December 31st wasn't year-end housekeeping. It was the system providing emergency capital to prevent cascading failures. The Federal Reserve understands what's happening. They removed borrowing caps in early December before the crisis peaked. They provided unlimited liquidity precisely when silver positions faced maximum stress. They're managing the unwind in real time, trying to prevent a disorderly collapse. But management isn't resolution. The underlying problem remains. There are more paper claims to silver than silver exists to satisfy them. No amount of Federal Reserve liquidity changes that fundamental math. It only delays the reckoning. Look at what institutions are doing, not what they're saying. JPMorgan flipping from short to long. Banks converting ETF shares to allocated physical. Private wealth offices securing vault storage in Singapore and Zurich. Family offices taking delivery of bars rather than holding paper claims. The rotation out of paper and into physical represents a loss of faith in the system itself. If silver contracts can trade at a $60 discount to physical reality, what does that say about gold contracts? About copper? About every commodity priced through derivatives rather than physical transactions? Gold premiums in Shanghai have remained elevated throughout 2025. Central banks bought over 1,000 tons of gold for the third consecutive year. China, Russia, India, Turkey, and dozens of smaller nations are systematically converting dollar reserves into physical metal. They're not buying paper, they're taking delivery. This is de-dollarization made tangible. Every gold bar that moves from London to Shanghai is a bar that will never back a COMEX contract. Silver follows the same path, but faster. The industrial demand that doesn't exist for gold creates constant physical drawdown for silver. Every solar panel installed is silver that's gone forever, embedded in glass and aluminum. Annual silver recycling recovers roughly 180 million ounces. Annual industrial consumption now exceeds 600 million ounces. The deficit is structural and growing. The supply crisis was visible years ago to anyone who looked at the data. What was hidden was the scale of paper positions betting against this reality. For years, the short positions suppressed prices despite the fundamental tightness. Paper supply overwhelmed physical scarcity. That dynamic has reversed. Physical buyers now set prices in Asia. Paper markets in the West can print whatever numbers they want, but manufacturers in Shenzhen and Delhi will pay what they have to pay to keep factories running. When paper and physical decouple this severely, the paper market loses its function. Price discovery migrates to where actual transactions occur. COMEX becomes a casino where gamblers bet against each other with chips that can't be redeemed for anything real. The endgame approaches faster than anyone expected. China's export controls are the catalyst, but the powder was already dry. 5 years of inventory drawdowns, 4 years of supply deficits, 3 years of record industrial demand, 2 margin hikes in 2 weeks, $130 in Tokyo while screens show 72. The numbers don't lie. The system is breaking. And those who understand what they're seeing have already positioned for what comes next. The weight of this moment will stay with the market for years, not because of the prices themselves, but because of what they reveal about the gap between financial reality and physical truth. That gap exists everywhere in modern markets. Silver just happens to be where it became visible first. The screen still shows $72. Tokyo still pays $130. And somewhere between those numbers lies the future of how commodities will be priced, traded, and controlled in a world where paper has lost its power to dictate terms to physical reality. The old system is dying. What replaces it hasn't fully formed. And the only certainty is that the people who saw this coming will be positioned very differently than those who trusted the numbers on their screens. But the implications extend far beyond trading floors and hedge fund offices. What we are witnessing is the first visible crack in a financial architecture that has governed global commodity markets since Nixon closed the gold window in 1971. For over 5 decades, the world operated on a system where paper derivatives determined prices and physical markets followed obediently. The assumption underlying everything was that paper and physical would remain permanently connected. That assumption is now failing its most serious test. The mechanics of how this happened deserve careful examination. When China began building its silver refining dominance in the early 2000s, few in Western financial capitals paid attention. Silver refining is dirty work. It's energy intensive and low margin. Western companies were delighted to outsource it to regions with cheaper labor and looser environmental standards. By 2015, China processed over 60% of global silver output. By 2020, that number approached 70%. The entire supply chain became dependent on Chinese facilities without strategic planners recognizing the vulnerability being created. The pattern repeated across critical minerals, rare earths, lithium processing, cobalt refining, solar panel manufacturing. Western corporations optimized for quarterly earnings while China optimized for strategic control over supply chains that would matter when geopolitical tensions escalated. The bill for that short-term thinking is now arriving all at once. Silver's industrial applications multiplied faster than any analyst predicted. The Silver Institute's demand forecasts from 2020 underestimated 2025 consumption by nearly 40%. Every model failed to account for the exponential acceleration in solar installations, the faster-than-expected adoption of electric vehicles, and the explosion of AI infrastructure requiring enormous data centers with massive power requirements. Consider the circular dependency now embedded in technology supply chains. A single AI data center consumes more electricity than a small city. That electricity increasingly comes from solar farms built to meet clean energy mandates. Those solar farms require silver paste for cell conductivity. The demand for AI requires more power, which requires more solar, which requires more silver, which raises costs, which requires more efficient solar, which enables more AI. The technology sector has become the marginal buyer of silver, and technology demand is almost completely inelastic to price changes. Apple doesn't halt iPhone production because silver costs more. They pass costs forward or absorb them in margins. Tesla doesn't reduce Model Y output. NVIDIA doesn't slow chip production. These companies need silver regardless of price, and they have the financial resources to pay whatever the market demands. Industrial buyers are now competing directly with investors for a shrinking pool of available metal. This dynamic has never existed at this scale in silver markets before. In previous price cycles, investment demand drove rallies, while industrial users waited patiently for corrections. Now industrial users are panic buying at any price because their production lines cannot stop without the metal. India's silver imports set records throughout 2025. The country brought in over 9,000 tons through November, more than double the previous year. Indian buyers, both industrial manufacturers and investment-oriented families, are accumulating metal at rates that strain global shipping logistics. Containers of silver bars flow continuously from London vaults to Mumbai warehouses. The Middle East has emerged as another major demand center. Dubai's trading houses report wealthy buyers from across the Gulf region converting cash reserves to physical precious metals. Regional instability and currency concerns drive accumulation that has nothing to do with industrial use. Even Western retail investors have awakened to what's happening. Silver dealer websites crash under traffic surges. Phone lines remain busy for hours. Products sell out within minutes of restocking. Premiums on retail products, like American Silver Eagles, exceed 30% above nominal spot prices. The retail premiums provide another confirmation of true market clearing prices. If COMEX says silver costs $72, but retail buyers willingly pay over $90 for a standard coin, which number reflects actual supply and demand? The question everyone should be asking is what happens when the paper price finally adjusts to physical reality. The answer involves significant pain for those positioned on the wrong side. Short sellers face theoretically unlimited losses. When you short a stock, maximum loss equals the position value because prices can only fall to zero. But commodities have no ceiling. Silver can rise without limit when physical demand overwhelms physical supply. The 8 banks holding 212 million ounces short face a collective reckoning that grows worse with every dollar silver rises. If COMEX reprices to $100, their combined losses exceed $6 billion. At $130, losses approach $12 billion. At $150, the numbers become existential for individual institutions. These aren't hypothetical projections. Physical silver already trades above $100 per ounce in major Asian markets. The COMEX price has become the outlier, not the global norm. The paper price is the anomaly that must eventually correct toward physical truth. The Federal Reserve's emergency lending signals acute awareness of systemic risk. Regulators understand that a disorderly silver repricing could trigger cascading failures across interconnected markets. Silver derivatives are embedded in structured products, bank balance sheets, and hedge fund strategies in ways that aren't publicly visible until they blow up. The 2008 financial crisis demonstrated how seemingly contained problems can rapidly become systemic when leverage and interconnection exceed what anyone mapped. Silver might be smaller than mortgage markets, but the web of derivative exposures is equally opaque. Central banks don't inject record liquidity during holiday weeks when trading desks are minimally staffed unless something requires urgent attention. The timing of December's operations leaves little ambiguity about the underlying cause. What comes next depends on factors no single institution fully controls. If Chinese export restrictions tighten further, physical shortages will intensify beyond current levels. If industrial demand continues its growth trajectory, annual deficits will widen. If investors keep converting paper claims to physical metal, exchange inventories will drain toward zero. The path to equilibrium runs through either managed repricing or chaotic collapse. Managed repricing requires banks to cover shorts gradually over months, while exchanges carefully manage delivery obligations and margin requirements. Chaotic collapse occurs if delivery failures become undeniable, forcing cash settlements that officially confirm the paper price as disconnected from reality. The CME Group and LBMA are working desperately to prevent the second outcome. Their tools are limited. Margin adjustments, position limits, rule modifications, trading halts in extreme scenarios. Each intervention carries its own costs and risks. Heavy-handed actions destroy confidence in exchange integrity. The next several weeks will reveal which path the market takes. Watch the COMEX inventory reports published each trading day. Watch the delivery notices showing exactly who is taking physical metal. Watch the lease rates indicating real-time borrowing costs. Watch the premiums reported from Shanghai, Tokyo, Mumbai, and Dubai. The data will reveal the true story before financial media headlines catch up to reality. Physical silver at $130. Paper silver at $72. The $60 gap between those numbers is not a temporary anomaly or a data error. It's a market confessing that the system built on paper promises is breaking under the weight of physical scarcity. Those who recognize this dynamic early have already repositioned. Those who recognize it now still have time to act. Those who wait for official confirmation from mainstream financial sources will find themselves competing for metal that simply does not exist at any price they're willing to pay. The great silver disconnect of 2026 is not an ending. It's a beginning. The beginning of a new era where physical possession determines value and paper claims return to what they always fundamentally were: promises. And promises, unlike physical metal, can be broken.